Joining us at Post 9 today, Pulitzer Prize-winning New York Times columnist Jim Stewart, who talks to James Stack, who called last year pretty well.
He did. You know, I was getting a lot of questions. Are you going to do your prediction column this year? And I was thinking, I don't know. Nobody's ever right. So I went and looked at last year, and I said, oh my God, this guy was right on the money. So I went back to him. One thing I like about him is he really relies on historical data. And he's not a perma-bear. He's not one of these people who's been saying for the last 5 years that we're heading into another recession. So he's usually bullish, and he thinks that we are in a bear market now.
He believes the market overreacted maybe in December specifically, right, to announcements, warnings that he thinks may still be coming.
Yeah, that's correct. I mean, one of the things the data shows very clearly is the economic data doesn't tell you you're into a recession often until you're already out of it. It's the lagging indicators that really prove that we've had a downturn. So you can't wait for any of that. Like the employment report is not really a leading indicator, which people were very excited about. I mean, that's all very good, but there are earlier warning signs, some of which are now starting to turn a little bit negative. And then I think his call was primarily based on technical factors, whereas in September, you know, valuations were very stretched. You know, there were a lot of technical indicators that were reaching extremely overbought positions.
So is the upshot bear market? Yes. Recession?
Well, that is the big question. And I've been doing some additional research into bear markets. And, you know, there are bear markets and there are bear markets. People say, oh, the average bear market does this, the average does that. But the average doesn't tell you that much because there are bear markets that precede recessions and there are bear markets that don't precede recession. You know, the famous saying that, oh, the stock market has predicted 9 out of the last 5 recessions. That's actually pretty close to the truth. The stock market is about 50% right at predicting recession. So, well, you might as well flip a coin. It's a little better than that because the market tendency is up, so you can't ignore it entirely, but it doesn't really tell you much. And the bear markets where there are recessions are really pretty bad. The bear markets where they're not recessions really aren't that bad at all, and they tend to be very short. Many of them are like 4 or 5 months, which if we actually had a bear market that started in September, and by the way, we haven't yet confirmed a bear market, it could be over now. So there's a very wide divergence. That's why I think this economic data is so important right now, why the Fed is watching very closely, and why investors are turning on a dime with every new release of data.
Jim, something else you don't get is apparently is 2 back-to-back down years very often, at least not since 1928.
Yeah, that's very rare, and I was kind of encouraged by that. I think that, you know, the odds of there being a second year, i.e. 2019, of a down market, history suggests are quite rare. And by the way, those only occur when in fact there is a recession. So if there is no recession within the next 8 or 9 months, I would say the odds are very, very strong that by the end of 2019 we'll be higher than we are now.
Are you sympathetic to Stack's point of view, though?
Well, I am sympathetic. I mean, it wouldn't, we were already down like 16-point-something%. Only a few more percentage points would take us to the bear market level. We could get that with this volatility. We could get that in 1 day or two. And by the way, this high volatility is very characteristic of both market inflection points, which may be a peak or it could be a bottom. Like March of 2009, which was a bottom, also had some of this very, very high volatility. Unfortunately, so did the fall of 2008 on the downside. So these sudden big rises that we've seen lately don't really matter that much, I think. But we could still have a bear market, say, by March, and yet still in 2019 higher if there's no recession.
I think you have to look, Jim, at the fundamentals, right? I mean, yes, we'll watch the data, but also one of the chief concerns since September is that the Fed is moving too aggressively on rate hikes and was not flexible enough in changing their outlook. Jay Powell went a long way to soothing the market's fears on that, didn't he, on Friday?
Yeah, I think he did. I would have liked him to say just a little bit more about why they were so confident about raising, because I'm assuming they have some data that the rest of us are not privy to. And by the way, the employment numbers seem to confirm a very strong economy. But it was heartening to hear him recognize that they're not blind to all these other factors. And by the way, even though their predictive capacity is not huge, stock market prices are a leading indicator. They're one of the earliest indicators of potential trouble. So it was very heartening to hear him recognize that there could be problems on the horizon. But I think it's also worth bearing in mind that the Fed doesn't totally control this. I mean, the indication that they might put the brakes on this or even cut rates would definitely moderate selling tendencies, but it doesn't guarantee that there won't be a recession. The Fed's track record is not all that fantastic at engineering the so-called soft landing. We are in a rising phase, and again, history suggests that it's a very tricky thing to sort of thread that needle and know exactly when to stop cutting.
Although you got mortgage rates awfully close to 8-month lows here.
Yeah,
you got, just as a stock play, I mean, Home Depot today is back above the 50-day moving average for the first time in almost 4 months.
Well, I think that's a very significant number, that end-of-year commentators were focusing so much on the rise in interest rates, the short-term rise, but the 10-year has been in a rallying mode pretty much, even as the stock market has been going down. And I think the lower mortgage rates, the lower 10-year rates, a lot of rates depend on that 10-year thing. There's been some loosening there, and I think we'll definitely see some.
I don't know though, which should we fear, lower rates or higher rates? Because higher rates are indicative of a stronger economy and a Fed that can continue to normalize. Lower rates suggestive of the opposite.
Well, especially if you get to the famous inverted yield curve, which we got extremely close to, another predictor of possible recession. On the other hand, I don't think rates in and of themselves, higher rates, lower rates, are all that determinative. I mean, there's no doubt in my mind that higher rates are going to dampen future activity and lower rates are going to ease it up. So at the moment, it might be signifying some weakness, but the way to get out of that weakness is to see rates go down. So I think it's a very healthy market correction. And by the way, I will say, the market going down here, having had this, everybody I talk to thinks this is a healthy thing. I mean, we've been going up, 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 up. People have been forgetting about risk, forgetting about the fact that markets go down, forgetting entirely that, yes, there are bear markets, and a bear market is 20% decline and even more than that. It's putting some awareness of risk back into the market, and it's improving asset allocation. I think it's a healthy thing.